Propertyology regards right now as a very exciting time for investing in Australian real estate. There are some fantastic opportunities that Propertyology can help you take advantage of before buyers re-emerge from their coronavirus cocoons. Propertyology has a national focus. Now more than ever, experience and knowledge are the most valuable currency. Propertyology has that in spades. To find out how Propertyology's multi-award-winning buyers agents can help you prosper, contact them now at propertyology.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Welcome to the show. I've been talking about it for ages, like waiting for Godot, something that never happens or comes. Anyway, my guests are laughing and smiling at the moment. I've been talking about a Q&A episode for quite some time, and here we are. It's Friday afternoon, just after lunch, and I've pulled a couple of people in the studio and I said, let's get this Q&A done. But they've been stacking up. I love doing these episodes. We want to do more of them. And today it's all going to be the audio questions that we get. So if you're listening to this on the Smart Property Investment Show, or if you're not listening to this on the Smart Property Investment Show, go to Smart Property Investment and you'll see at the bottom of every single podcast, you can press a button that says record your questions. So we're going to play some of them out today and we're going to answer them on air. I must admit, and this is a very deliberate thing, I don't know what the questions are, and the guests I have in the studio today don't know what the questions are. And the reason why we're doing that is that you actually get the raw, authentic, off-the-cuff response based on our experience in property. My experience in property is very much as you will know, a journalist, so in the business of content aggregation and curation and understanding what other people are saying. And, you know, I'm at a point where I sort of start framing my views on it, so I'm happy to lend my 2 cents on any of these topics or any of these questions that are posed by our audience. The two people in the studio with me, Steve Waters and Victor Kumar, they're both directors at the Right Property Group. They've come and joined me. They can speak with more authority. They've been here for quite some time. They're buyers agents if you don't know them. And what you get from me is probably going to be very different to the responses that you hear from them. We're going to keep it raw. We're going to keep it organic. We're going to keep it uncut. That's what we've been told that you like. So bear with us, hold on, and hopefully this goes okay. Gents, how you going? You well? Steve?
Going well, mate. It's great to be back again.
And Victor? It's been a while since you've been on the
really
show.
Well. It's been a while.
Welcome back. It's good.
Thank you. I feel privileged.
Yeah, well, you should do. Yeah.
And there we go. Straight away.
You're in the inner sanctum now.
Do you know how many people would love to be in that spot right now talking about property?
Absolutely. I feel really privileged.
In jest. But all right, we're going to get into it. We're going to go to the first question. So I have in our studio James, our producer. He's the guy who's in charge of lining up and queuing up all these questions. We've got 4 of them. We'll get through them. We've got about half an hour or so. James, you want to play the first question? Hopefully it's not a doozy because this is all off the cuff.
Hi, Phil. My name is Steve from Geelong. I have 4 properties currently, looking to round out and complete my portfolio by 2025. My question is regarding the purpose of each property. I believe you should know the purpose of each purchase. Is it for yield, it's for capital growth, or it's for development later? My question is, does this often change depending on the market as you move forward? For example, I have a property on the Gold Coast. I think I will keep that forever as a yield property, but perhaps Gold Coast goes through a boom and suddenly you could sell it for a lot more. Where a property down in Geelong might be for a capital growth play, in 5 years' time it hasn't grown at all. So you may as well hang on to that for the yield. So that's my question. I know that each time you buy a property, it should be put in for a very clear purpose into that portfolio. How often does that change depending on market conditions as you move through the years? Thanks, guys. Love it.
Steve from Geelong, great question. And we could probably just cover a whole podcast off of that. You've brought up a lot of different dynamics of investing in property nuances. And I would assume, it sounds like you've been in this for a little while, you would lend yourself to being on the sophisticated side. The fact that you're having these thoughts and these patterns of digging down deep into your portfolio says to me that you're driven towards improving your portfolio and creating wealth. The way I would probably frame my response to this, and Steve and Victor might see it differently, is that I'm going to pull or use a phrase that Victor Kumar has used before, and that's about pigeon-pairing properties. And what you're talking about right now, Steve, is pigeon-pairing properties. So this is pairing up properties which are capital growth opportunities with yielding opportunities. So you need to underwrite and carry the cash flow of a capital growth property, but you link that to, or you tether it to, a higher yielding property that helps support that cash flow. The yielding property might not go up in value over time. And I think to your question was in the Gold Coast, to a property which might not yield very well, but it should have long-term capital growth. Victor, this whole sort of concept of pigeon-pairing properties, that still remains the same as it always has done?
It still remains the same. And often when you do hit hurdles along the way as you're building your portfolio, and sometimes the market is not favorable to implement the full strategy on the property, it may be that you need to take a step back and wait for the market conditions to be favorable. And the market conditions could be something as simple as your ability to get a loan, to explore the full strategy on that particular property. So as an example, it could be a subdivision property. And if you're not able to get the finance for it, don't pull the trigger on it just yet, right? So what you'd want to do is then underpin it with other properties. And this is where a good, well-rounded portfolio comes into play, where you've got properties that can sort of, whilst sitting independent of each other, can also lean against each other and self-support each other, so that the entire portfolio is on a stable platform. And that way, let's talk about in terms of change in environment, change in economy and all that. If that happens, then you've got the ability to hold on and then implement the full strategy down the track, right? So now, again, coming back to the purpose of the property within the portfolio, sometimes it means that you just need to delay the execution of it. But that doesn't mean that if it doesn't pan out, that you start off thinking of offloading or looking at, it as a not a good property within the portfolio itself. Rather, you'd say, okay, this is not the time to implement the micro strategy within that macro strategy that you've got within the portfolio. So you need to then obviously live to fight another day, live to actually be able to leverage off your hard work in the initial stages to then actually implement it at some point in time.
And to Steve's point, it was around the repetition of the review of your portfolio and how, when you should do it, how you should do it. Is it at a time when you purchase a new property, or is it after you purchase a property to reset for the new one? What are the best investors doing in terms of the perpetual awareness of their portfolio and how they can ensure that is as best as possible to support future growth?
I think he's done a tremendous job. Clearly, Steve knows where he's going.
You can tell he's sort of thought a lot about this.
Absolutely.
And he's been doing a bit about this.
I mean, he's mentioned the fact that
this is not my first investment.
No, every property
has got a purpose.
Has a purpose for being there, and that is something that we talk about all the time. I think the perpetual awareness, as you put it, is absolutely paramount. And the fact that he's even thinking about that shows his elevated sophistication levels, if you will, because too many people come into this just with their eyes wide shut rather than with purpose. And I think he's got the formula well on its way to being correct, because as he said, it might have been, I think it was his Gold Coast, which he'll keep forever because that's a cash flow scenario, and there'll be an element of growth there, and there always should be, but some properties have a heightened cash flow scenario. At the end of the day, that's what we're after cash flow with zero debt as well as growth, because that's the wealth component. And so if he's using the Gold Coast, I think it was, as an example of the income when the debt is retired, then he's got Geelong, I think he said, as more of a capital growth play, because Melbourne traditionally is a lower cash flow, but he's got that capital, that potential to manufacture capital amplification. He's actually pigeon-paired it, if the two properties as opposed to the four, and I think that's perfect. I would probably just mention that the continual and ongoing assessment is critical. Even though you may be doing it, having a finger on the pulse of the different markets, because they all move randomly, and sometimes there's spikes within those markets, is absolutely critical. So if it's his Geelong property, which it might be not just capital growth, but there might be a development potential at the back of it, and we know it well because we buy plenty there, that is getting the ingredients of the market, knowing when to pull the trigger to develop or to add the secondary income or whatever it may be. And you can only do that when you're continually assessing and having a finger on the pulse.
And sometimes it is just being patient. And he mentioned that there hasn't been any significant growth in the last 5 years, right? So when I bought my very first property, which was in Campbelltown in New South Wales, back in 1999, for 12 years, Campbelltown had not moved. And everyone was saying, why are you buying there? And Campbelltown then woke up, in inverted commas, and we had pretty much a doubling effect within the next 3 years. Now, I'm not saying that every property will do that, but at some point in time, there is a catalyst that happens in the market that then surges the growth, so long as you've addressed the fundamentals. And if you're looking at the Geelong property in itself, it's got great fundamentals in terms of lifestyle, in terms of distance from CBD, affordability, and also assuming that you can do something with the block, it's got the value add factor as well. So it's a matter of biding your time and knowing through constant reviews as to when to pull the trigger, so that it is financially safe, and not pulling the trigger a bit too early so that then you're then robbing the equity of other properties to then show up this development, right? So it needs to be a standalone within itself, so that if it does go pear-shaped for whatever reason, you've only impacted the performance of that property rather than the entire portfolio.
I'd say though that he's well thought. Like he's done this very well, Steve. I think there's been some deliberate actions along the way, and it's now just a matter of timing and being patient to be able to execute the opportunities as they evolve.
To your point, Victor, about your experience in Campbelltown and this notion or concept of pigeon pairing, and that is really offsetting negative cash flow with a cash flow producing property to create value capital growth in one. So as a strategy, it's an important point you make is that if you get the timing in property is everything, and time in property is everything as well. So, the Holy Grail is that you buy at exactly the bottom of the market and you get all of the growth in it. And no one really does that, and you can never really time the market. But what you're saying is pigeon pairing is a mechanism for you to actually be in a market which at a point in time should realise capital growth. So,
absolutely. So I'm going to play that out a little bit different. So let's say you bought at the height of the market, right? And the minute you bought, it's starting to plunge in value. Most people panic and try and sell. But so long as you know the growth patterns and understand the growth patterns, the drivers of growth in that area, it will bounce back up, whether it is 1 year, 2 years, 10 years, right? So you need to buy yourself time. And to be able to buy yourself time, you need to bring it back to your household budget. And if it means that this particular property is introducing a lot more of a negative cash flow, perhaps you can dampen that effect by buying another property that is a higher yielding, provided you've got the capital to buy another property that is higher yielding, to offset to a degree the negative cash flow this particular property brings that hasn't grown in value straight away. But the fundamentals are good. And one of the things that most people get wrong when they're investing is that they expect growth every single year. That does not happen.
It's not lineal.
No. Okay. Steve, great question. Thank you so much for recording that. Remember, press the button, record now, send your questions in, and we will answer them on air. We're going to go to question number 2, but we'll go to a break beforehand. Back in a moment.
Love property? The current Buyer's Agent of the Year and Director of Pure Property Investment, Paul Glossop, does too. And right now, he's offering you the chance to secure his best-selling book, A Surfer's Guide to Property Investing, absolutely free. Simply jump on Pure Property Investment's Facebook page, hit the message button and type Smart Property to claim your free book today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with my guests in the studio today for our Q&A session, Steve Waters and Victor Kumar, both directors at Right Property Group. James, producer, let's get the next one played, mate. We'll get it answered.
Hey, guys. I've been looking into high LVR loans because I want to get to the market as soon as possible. I know it's risky, but what do you reckon?
What do I reckon? Okay, so let's do some definitions beforehand. LVR, loan-to-value ratio, so debt versus value. High LVR means that over 90% or anything over 80%. Let's say anything over 80% is a high LVR loan. Depends on the market. Way back when, you would have been in the market at this point in time, they were giving 103%, right?
Absolutely, so 110 even.
Do you know what? I never did it.
You never did it? I never did it. That was before my time. But so that's when you're borrowing more than the value of the property on the basis that is going to go up in value, right? I think those days are long gone. But anyway, that's what we're talking about, high LVR properties. Now, for a lot of first-home buyers, often they might pursue this route. So this is the dichotomy between saving up a bigger deposit so you can buy a house at a lower LVR, or getting into a house earlier by going to a higher LVR property. So if you borrow over 80% of the property value, you need to pay, whether you're an investor or you're an occupier or a first-time buyer, you need to pay LMI, which stands for Lender's Mortgage Insurance. So you pay the insurance for the lender just in case you default on the property. So there's some high-level terms and concepts. Go and get familiar with them if you're going to operate in this space. Get educated. Some people say, don't get LMI because it's a cost. Other people will say, use LMI as an advantage and enabler to get you into a property sooner. The logic being, if you get in now in a market that's going up, you're going to get a greater, longer tail of the growth. The negative or the inverse of that, if properties are going down in value. So, Steve, your views towards high LVR borrowing per our question that come through, and you didn't share your name, so we'll just call you
Jack.
Jack's
back. It's
thoughts?
Horses for courses.
Yep.
At the end of the day, there's LMI we see it as a cost of business, and you'll find that a lot of investors that have been doing it for some time now want to leverage their capital as far as they can. For one or two reasons. A, they don't have enough. So the high loan to value ratio enables them to get into the market, or they might have a pot of capital where they want to leverage it. So instead of, let's just call it $100,000 just for math's sake, instead of buying one property at 80% LVR, they might want to split it and buy two properties. Yeah. The important thing here is understanding, in my opinion anyway, is that it's really, and we're assuming that this is a first purchase as opposed to leveraging off an existing
Let's make
property.
that assumption just for the sake of answering this question. And if we got that wrong, we apologise and we can answer it another time, but it's a first purchase.
I'll answer it actually in both circumstances, because if it's first property, you've saved up an amount of capital, and there's a question you need to ask yourself is, do I take the higher loan to value ratio to get into the market, or do I actually wait until I create a bigger capital, therefore a lower loan to value ratio, let's call it circa 80%, to get into the market? Now, there's a couple of problems or pros and cons of that. The pros are, well, it's a reduced debt, so therefore the cash flow theoretically should be better. The interest rate might also be a little sharper. But the con is, if you wait for the time to get into the market, I'm being quite general here, not knowing the circumstances financially, is that you might miss an element of the market. So even if you miss circa 2% of growth, as an example, at the best case scenario, that's a hell of a lot of money that you would not have been able to save to get into that market. Now, I'm being very, very clear here, horses for courses. If, however, that you've already got an existing property portfolio, whatever it may be, and you've got a certain amount of capital, then other than the lender's mortgage insurance component, it's debt shuffling. It's where you attribute the debt.
Debt's got to be somewhere.
It's somewhere. It's just a matter of where you put it, psychologically or on paper or whatever it may be, because you might be drawing down equity from another house, debt, to go over and purchase property number, whatever it may be, debt. It's just borrowed money. It's where you utilize it.
And a lot of people actually use their principal place as residence as a vehicle for manufacturing income, so they can get deductible debt versus non-deductible debt. And Jack is not Jack. I've just been updated. It's Darren. Darren, thanks for sending that note, and hopefully we're answering it. Can you quickly have a chat about this? You know, the difference between going a high, it's say you actually have a principal place residence or you already have debt somewhere else. Principal place residence is probably a good one. Drawing down money from that to use in having a 80% lend instead of a 90% lend and using that as tax deductible debt. Victor?
Absolutely. So let's step back one first. When you're looking at getting into a high LVR position, there is a sweet spot. And the sweet spot usually is 88.8% LVR rather than 90%. Now, most mortgage brokers, if they are not experienced, they'll take you straight to 90%. And it is the basically the tiers in terms of, if you go to 90%, you're paying a higher percentage in terms of mortgage insurance premium, as opposed to leaving it at 88.8%, you're paying a much lower premium as such. So you need to make sure that that's been instigated. So coming back to your question in terms of leveraging off the home and borrowing the 20% or 25% from there. So if you're buying a property, obviously you need a deposit, you need money for stamp duty, you need money for the solicitor's cost and so forth, right? So you need to have that money available from somewhere. Often what the banks will do is they will turn around and say, you know what, I'll give you 100% of what you need. In other words, I'll give you your money for your stamp duty, I'll give you money for your deposit, I'll give you money for your solicitors, and I can even actually give you a little bit extra as well. And for that pleasure, bring me your house and bring me the investment property, and I'll put it under the same umbrella. Cross-collateralize it. Yep. And, you're not paying any mortgage insurance in that sense. So probably one of the cardinal mistakes of investing, because what you're doing is you're actually putting your home straight in the line of fire if for some reason the investment doesn't work out. Right. So you need to then obviously, you can achieve the same thing by setting a facility against your home with Bank A, and set up a separate account to say that, okay, he is, say, and I'm making these numbers up, say $50,000 for my deposits and my stamp duties, and Bank B coming in at 80%, here's my loan for the investment property. So when you're buying it, you're then creating that account from the principal place of residence, buying it across to the vendor or to the solicitor, and that becomes a deposit, and the bank funds the rest.
It's
right?
a firewall.
Yeah, it's a firewall. Yeah. Now, if you're going in at a high loan-to-value ratio, in that sense, the danger there, and again, I agree with Steve, it's a business decision, right? So you need to make a business case for it first to say that, okay, if I've got $100,000, can I make it last over 2 properties? Or do I just plow it all into the one property and it's quarantined in there? When you get into this high loan to value ratio, you need to really come back and drill back into your own personal financials to say that, okay, can I hold on to this debt? How many zeros does it have in terms of the holding cost per week for me to chip in so that I can hold on to this entire debt? Forget the hundreds of thousands or millions of dollars in debt. It's how much you're forking out per week from your PAYG income or from a cash flow to hold on to that debt. And so long as you address that first before you get into this high loan to value ratio situation, you should be fairly safe. Because what it does when you're getting into a high loan to value ratio situation is that it sort of precludes the number of lenders you can approach should things go wrong. Whereas at 80%, you can go to a 90% lender at some point in time.
You can actually pivot
That's right.
if you're at 80%. And I think I might have said it, but during the 90 or 95% loan to value ratios, there's a higher interest rate, and you're kind of stuck as well should they ratchet the rates
You
up.
can't have your cake and eat it.
Well, that's the
compromise the whole way through.
Yeah, and the question is, do I get into the market or I don't?
Yeah.
And
that's the real question.
And only you will know that based on your own income and expenditure.
And that goes to Darren's sort of point around risk.
Correct.
Right?
Yeah, and the other thing that you probably need to look at is if I want to save up 80%, how long am I out of the market and where do the prices go at that point in time?
Yeah.
Maybe think outside the square. And if you are talking to a broker, make sure they're a good one.
Speak to a good broker. This is really tactical, and what you just spoke about then, Victor, around how you can actually shape it by using your principal place of residence to help finance a lower LVR loan with different lenders or a line of credit or stuff like that. That's when it gets really, really tactical and you need a good broker.
Here's a question. Yeah. Even though it's your podcast.
No, go ahead. You can ask. As long as it's not directed at me and it's hard.
Well, it was. And It is.
Yeah, no,
for the both of you, do you think there's ever time to actually activate cross-securitisation?
I'm going to lean on the crutch of I'm just a journalist and I'm not qualified enough to answer that.
You just bailed out. You played at the fifth.
Look, the ends justify the means, right? So long as you take a safe approach, sometimes it is necessary to cross-securitize, because if that's the only way you can get the lending and you've got a clear intent to uncross it at some point in time to then segregate the 2 properties, I'm all for it, right? But you need to go in with your eyes wide open as to what you're getting into.
Yeah, good answer. You pass.
No, I'm going to answer it.
Oh, what after he's given the answer? Now you're going to do it? It's
I thought
He's a typical journalist. What do you think?
I thought Victor's response was pretty mediocre. The way that I would answer it is that if you see a mortgage broker or a bank and the first thing, if you say, I need debt or I need to buy this place, and the first thing they say is that, what have you got right now? Let's cross-collateralise your property so we can refinance it all and the one need to be bundled. That would be a red flag for me. So I'll draw on your answer in that, the ends justify the means. If you need to explore every other option before you cross-collateralise, is what I would say. And if someone presents to you initially straight off the bat a cross-collateralisation strategy, mortgage broker or bank, I'd go and get a second opinion.
You go straight to the top of the class.
Yep.
That's a good answer. I agree 100%. If the broker's first avenue is cross-securitisation, then paints it up as you don't need to put any of your own money into this because we'll just take it out of this, then it's a red flag. If, however, and here's the ultimate example, if you will, let's say you own number 1 Smith Street and it's a zoned play, if you will. Number 3 comes up for sale, and the only way that you can access the ability to be able to purchase that is to take 20,000 out of this, 20,000 out of that, 20,000 out of this, and 20. Then you must explore that option. But going into it, knowing what the pros and cons and what the potential consequences are.
Ends justify the means, and I think it's a really pragmatic way to approach property investment, but be informed, be educated. Hopefully that's why you listen to this podcast. Quick break, gents. We'll be back in a moment.
Worried about making the wrong choice with your next investment? You're not alone. If you truly want to become the master of your own lifestyle design through real estate, then you need to speak with Buyers Agents, who'll help you acquire cash flow positive properties in high growth areas with value add potential, so you can create more freedom in your life. Visit dash.com.au/SPI.
Welcome back, everyone. Phil Tarrant with Steve Waters and Victor. I was about to call you Steve Kumar and Victor Waters.
It's a bit of cross-pollination.
Cross-collateralisation. I don't know how I get that wrong. Steve Waters and Victor Kumar, Smart Property Investment Show, Q&A day. I hope you're enjoying it. Remember, send your questions in. I really enjoy it. You can probably tell answering these type of questions, and we should really be videoing this stuff. It's completely off the cuff. We don't know what's coming down the airwaves. James, if you can get ready to start playing our next question. We've got 2 more and we've got about 10 minutes, so stick with us. James, press play, please, sir.
Hi, it's Toby here from Wollongong. Just looking to sell an investment property that I have, and would just like to know, in your opinion, if you think it's better to sell the property privately or if it's better to take the home to auction. Thanks.
Thank you very much. I think that's Toby. Mate, Wollongong, great place.
Excellent place.
I think you guys have been active down there, so I'm probably going to lean on you on a particular point of how I would answer this. And I would say it completely depends on
Good answer.
Where you are, what the market is like, what the culture is for property sales in that area, what the agents are like, what the auctioneers are like, what your particular circumstances are, the speed at which you need to move. Everything is up to. And this is, you need to find a good real estate agent that should give you a good recommendation. As you talk about private, so we can either say it's a private sale, completely outside of the realm of real estate, and you do it for sale by owner. That's a very different thing.
Suggest not.
Yep. So let's stick with the decision between like a private, just a
private
sale
treaty.
Private treaty,
Yep.
or auction.
I think it depends, and we know Wollongong intimately.
We're just assuming that his place is in the Gong.
Didn't he say Wollongong?
Did he say it was in Gong? No, he's from Wollongong. Yeah.
May not necessarily be that his property is in Wollongong.
Let's just assume.
Let's just assume.
Wollongong, anywhere Australia, but let's use
Anywhere
Wollongong.
Australia. So
the Gong. I think
the
we're
Gong.
gonna call it the Gong.
The
It's
Gong.
great. The Gong.
It really depends on, for me anyway, the property type and what the potential components of that property is. So what is the upside and who am I trying to appeal to? So as an example, it might be just a standard owner-occupied potential property that's got great street curb appeal and would really suit the family, the first home owner, or it could be something that has a bit of zoning around it that would appeal to potentially an investor and maybe the owner-occupier, if you will. So depending on the type of property and what its upside is, would be the very first thing I'd be looking at as to whether I take it to auction or whether I take it to private treaty. The other thing I'd be considering is the tempo of the market. That's a very, very important asset or part of the picture for me, because usually in our capacity, having bought $1 billion worth of property, the tempo of the market will dictate the auction, but also private treaty, to be fair. But the whole idea behind an auction is to create hysteria amongst buyers. Yeah. Now, if they don't have that hysteria, then quickly the agent makes the auction as a tool in their favour. Nothing against agents that may be listening to this.
We love agents here on the Smart Property Investment Show.
We love agents
Don't give them a
everywhere.
hard time.
No,
they're your bread and butter.
They're my bread and butter. Call me.
Yeah.
But an agent uses an auction as a great, what we call conditioning tool as well. So you take number 1 Smith Street to auction and you think it's worth 700,000, but bidding gets to 600. The agent very quickly uses that as what we call a conditioning tool. The market has spoken. Bidding stopped at $600,000. Therefore, it must be worth $600,000. Drop your expectations. So there's actually pros and cons for it. My suggestion would be to get several, being 3, 4, 5 agents through, create and give you what we call a market appraisal. Now, that's industry standard, and a market appraisal is very different. Think of a market appraisal as a pitch to get your business. But the rhetoric you need to go to the agent is, don't give me the market appraisal and give me all the data that I have anyways. Tell me what it will sell for. Don't buy my listing. And it's a really important point, because you need to speak the same language as they do so that they understand that you understand. So what it will sell for. And if they come to you with an auction campaign saying you should take this to auction because of X, Y, and Z, know that there's a budget behind that. Now, I am kind of cornering myself in here for agents not to ring me ever again, but it's the truth. You need to look at all avenues, but you also need to make a dollars and cents economic decision. You want the biggest exposure, but it comes down to the type of property, what the market is doing, and what it will do for you.
Good answer.
Yeah. And what you need to also look at is what's the modus operandi for the agent, right? Some agents are pro-auction and they take everything to auction and they sell, right? And there are other agents that will never take a property to auction, but they would also sell. Or there'd be other agents that'll take things to auction but never sell, right? Because they don't have a big enough database. So I think it comes back to you need to research the agent rather than the mode of sale and decide on that and see that who's got the biggest exposure in the area and also has got the most runs in the board. So just because they've got 100 listings as opposed to someone who's got 50 listings, and the guy that's got 50 listings is getting above what they're listing for, you need to drill down into that to say, okay, are they listing it too low to begin with? Or are they listing it at a fair price and they've got really good sales processes that pushes the buyers up above the expectation? And same with the auctions is, have they got good enough processes? So perhaps before you make a decision, perhaps attend a few of their auctions, perhaps attend a few of their private trees, see what the follow-up is like.
I think that's a good idea because the quality of the auctioneer will determine sometimes the quality of the result.
I was going to say that how important is auctioneer, and I think of you guys. I do the What's Making Headlines every Thursday on Facebook Live with Tom Panos, and he's a good auctioneer.
He's a great auctioneer.
And for me, good is pretty good.
I don't think I'd ever be able to buy off him because I couldn't work him.
So the auctioneer is a vehicle for harnessing the emotional energy, creating theatre around it, and driving the price up. That's
the emotions
their job.
up. Driving the emotions up, the fear of missing out.
Well, it's the tempo of the auction will be a direct result of the auctioneer, but also the result. So if you've got an auctioneer that is below average and who's reading off a script, there's no tempo within that auction. And I've been to auctions where literally we're making $100 bids. But I've also been to, because they're perhaps below par, but I've also been to auctions where the auctioneer will not accept my games and tricks and everything like that.
They're good operators.
They know what I'm doing. They
got a response for everything.
Yeah, I've got that guy. I've got him covered. And so, but they create the tempo, which then creates hysteria potentially, and people get caught up in that. And as a buyer, the very first thing as buyers advocate, the very first thing we want to do is halt the tempo. We want to disrupt the tempo.
The auctioneer and what the auctioneer is trying to do and what you're trying to do as a buyer, and you're representing other buyers, but as a buyer's advocate, is completely the opposite. You're trying to stifle.
Bipolar. Yeah.
You're trying to stifle what the auctioneer is trying to achieve. And we're going to start talking about buying property. If you're buying at auction, you're up against people that know what they're doing. So my recommendation would be go and watch a lot of auctions and watch really good auctioneers and just watch how they do what they do. It is an art form, it is a craft. It's just not what they say. It's the speed at which they say it, the tonality of it, their pauses, their comebacks, and when they know they're really good, they will stop. They control it every step of the way.
They're a puppet master.
Yeah, exceptional auctioneers are exceptional. So, ask your agent if you're looking at listing, if you're selling. We're talking about selling in Wollongong. Going to your point around getting 4 or 5 agents in, you might think that's going to be an absolute nightmare. If you're serious about selling your property, you probably want to shop around for the best agents and don't get all the same agents that come in. Get someone who's been in the game a little bit longer, the old hand in the area, the young up and comer, someone from out of the, maybe a couple of suburbs down the road. Get a really good blend to actually understand, their price points, how they would market the property and the tactics they would use, and then how would they sell it, and ask them what auctioneers they use and go and watch those auctioneers.
We do that. That's a great example. If we're on the purchasing side, as an example, and we've got to buy number 15 Brown Street, and we know that Jack or Mary is the auctioneer and we haven't dealt with them before, we will literally, our recon beforehand is probably 2 months watching them at auction to see how they act. But I'd also say to Toby, I think it was, that maybe do some diligence yourself. So maybe mystery shop them firstly, but also pay a little bit of money for you to get your hands on the data beforehand. So that could be from CoreLogic.
At the point when they come into pitch. Yeah.
Before they pitch.
Let's chat about that really quickly. And there's so much science around this, and outside the scope of this particular podcast, good agents are very, very good. Their bread and butter is not necessarily selling the property, it's finding properties to sell. So if you're not in the business of real estate, you might not actually comprehend this. An agent has 2 jobs. Real estate agent has 2 jobs. Number 1, find properties to sell. And then the second bit is find someone to buy that property. The important part of being an agent is finding properties to sell. That's what makes or breaks agents. That's all about getting listings.
If you can't list it, you can't survive.
Absolutely. So it's all about securing listings. So the great agents are very, very good at listing presentations.
I'll even go a step further and say that the old school agent is near extinct. And that's the old school agent is the person that puts it into the middle spread of the Cumberland Times or whatever it may be, rather than working social media
now, right?
Yeah, they
There's
are.
No
There's
papers left.
But it's someone who's, dare I say it, flamboyant, who's out there, who's got a social profile that is just everywhere.
Selling real estate is so different these days. And you've got to understand also, and this is an important point, again, a little bit off topic, but is it an investment property or is it an owner-occupier property? And that's going to really dictate how
100%.
you choose to take it to market.
Absolutely. And because that's such an important point, and because of today's technology, you could potentially get a very switched on agent that is operating out of, if we take Wollongong as an example, they might be operating out of Nowra, right? Or Port Kembla and the properties in North Wollongong. Because of today's technology and the listing platforms, it comes down to their professionalism, their networks, their database, and the way they're able to give your property exposure, not just on page 37 of
What's the local rag down in Wollongong?
Mercury.
Illawarra Mercury.
See, just like that.
It just came out.
It just came out like that.
Illawarra
Well, I used to
Mercury.
live down there as a whippersnapper.
Oh, yeah?
I did. Used to surf at North Wollongong
I
Beach.
used to work down there as well. So
Did
there
you?
go. Yeah.
What, the
In
hospital?
Dapto. In Dapto.
In Dapto.
Dapto doggies. That's it.
Terry Hill, he's really, Dapto Dog's
Do you remember
favourite.
that?
You see how quickly I pulled that name out of the hat?
I know, you
Terry
were
Hill.
good. You
I
were
remember
good.
it. Thursday night, I used to sit there. I remember when I was a kid, Thursday night was Chinese food night where Mum would go shop and bring back the Chinese, and I'd always sit there and eat it watching
The Greyhounds.
watching Terry Hill down at Dapto Dogs on the footy show.
And that has changed substantially. Dapto's changed substantially over the years.
I was down there about 3 weeks ago. It is such an emerging area. So for Toby, like you might have the positive perfect storm brewing if that's where the property is.
And another important point around, is the property going to be bought by an investor or an owner-occupier? If it's an investor, they could be in Port Hedland. And they might be buying. I probably doubt it because everyone's lost all the wealth at Port Hedland. but they actually might be in Sydney or Melbourne or Brisbane. So investors, it's borderless, absolutely borderless. So you've got to keep that in mind and make sure your agent or whoever the auctioneer is enabled enough to attract people's bids from outside of Wollongong.
I'll give you some real-time data, if you will, and a real example of that. So I have a client who is on the other side of the world who is an investigative journalist, of all things.
Yeah.
And we just purchased in Wollongong for him from the other side of the world. And maybe for Toby too, there are such things as vendor advocates as well. But also maybe, depending on where the property is, we're assuming it's Wollongong, it could be, it could be Perth. If you want to reach out to yourselves or people like us to say, look, do you know any good agents in the environment?
Yeah. Do that. You can email us, editor at smartpropertyinvestment.com.au.
Because there is a very big difference between agents that we purchase from and agents that we don't.
Yeah, and the thing that you need to also take into account is don't get stuck on the commissions, the percentage commissions, right? Because you need to get stuck on the results and what they can do. So look at their track history. Someone that's charging 1.1% as opposed to the standard 2.2% as an example. Something's got to give.
You'll pay for what you'll get, and it's usually
exactly
been
right.
marketing and advertising.
And I'm going to leave this question on this point is the best properties that I've bought as a property investor are those that have been poorly marketed by bad agents.
Absolutely.
Correct.
Okay, we've got one more question. James, you want to play it for us? Thanks, mate.
Hey Phil, how are you going? So I have a very curious question. I wanted to know how you would deal with a dodgy tenant. I think, is there a way you can prevent from getting landed with one as well? Thanks, Phil.
The old dodgy tenant. We've all had dodgy tenants. I've been a dodgy tenant.
I was about to say, still are.
I'm a great tenant. No. So this is a really interesting question, and that's from Alex. Thanks for sending that in, mate. And it's something that every property investor grapples with at some point of their investing career, and often it's at the start of being a property investor is when you start thinking about this stuff. So I'm going to assume that you might be sort of newish to this or thinking about buying, or maybe this being one of the reasons why you don't want to buy a particular property in a particular location, or you might have an immediate problem right now. you're always going to have dodgy tenants, but your view of a dodgy tenant is different to my view of a dodgy tenant. It's different to Steve's view of a dodgy tenant. So let's define what is a dodgy tenant. Now, my view of what a dodgy tenant is someone that doesn't pay their rent.
Okay.
That's a simple definition for me. Dodgy is they don't pay their rent.
Yeah, dodgy is dodgy, but elements of dodgy are different.
But there's dodginess around. I'm a bit unsure about what they're doing to my house. Are they smashing down walls? Are they?
Yeah, I think that's the question.
That sort of stuff. Is that where it's at? Or they've got a drug den. Like if they're doing that, tell the cops about it and get them out of your house straight away.
Okay.
Yeah.
For me, I'm going to preface this by saying that, look, I've been a tenant, and this is not a them versus us or a landlord or a slumlord or anything like that. Like, let's be very, very clear. However, there are instances that I've experienced, and I won't use the word dodgy, I'll call them professional tenants.
Yes.
Now, there's an element out there that is not tied to the demographic either. So if I take myself as an example, I've got some more affordable properties that give me no grief in terms of a tenant point of view, but I've also got properties that get me $2,000 a week, and they're the ones that have given me grief in terms of the professionalism of the tenant. I would say that what's very important for you is that where the property manager now comes into play, this is where they earn their keep. I would also suggest to you that you be the squeaky wheel, that you document everything. You ask for documentation, you ask for evidence, be whatever it may be, and the rules or the protocol is followed to the nth degree. And depending on which state and what the property type is and what have you, that might be something as simple as what we call a breach. Or what a property manager would call a breach, and the documentation that follows that. How do you avoid it is the $1 million question, because think of and once again, please don't, I'm not being stereotypical here and don't hate on me, that whenever someone goes for a property, it's like going for an interview, essentially. When you go for an interview, you got your best demeanor, you got your best clothes and whatever it may be, and you're providing the best financials.
You're presenting the best you.
You're presenting the best you. And things can, for unforeseen circumstances, COVID, things can change anybody's circumstances, including tenants. And there is a time where you may need to be a little bit lenient within the law and within the documentation scenario. But your property manager is key here. And unfortunately, fortunately, whichever way you may look at it, sometimes you may think that the property manager is doing you a favour, but they're not. You're paying them a fee, and property management is a very, very unforgiving, and it's a hard job. And there's daylight between a good property manager and everything else. My answer to that would be communication. To sum up, communication, be the squeaky wheel, and make sure that all document is in place. And unfortunately, as an investor, every now and again, you will get someone that falls on hardship or / professionalism.
And it's okay to cut some slack to people. And all my properties, they're all managed by a property manager, which allows me to be disconnected with the actual individual. So I'm cut away from the emotions of it, right? But I cut people some slack. If it's fair and reasonable, that's okay. As long as there's long-term goodwill in the relationship and have been a good tenant up until that point. So, you got to be pragmatic and practical about it. Victor, sort of, would have had a few dodgy tenants over the years.
Yeah. So for those that want to hate Steve, it's 1-800-HATE-STEVE. But there are 4 elements to this, right? So there's the property, there's the tenant, there's you, and there's the property manager. So we need to be addressing all 4. So if you've got a dodgy property to begin with, and it's got safety issues, and it's really, absolute dump, it'll attract that type of tenant. So you need to be mindful of that. And the reality is that in some areas, what you consider as dodgy might not be dodgy, right, in terms of the property itself. Yeah. So it comes back to the social demographics of that area. Then the next thing you need to look at, obviously, is, okay, who is managing it? If you're trying to scrimp and save and you don't know the legislation, and understanding that most states are changing their tenancy legislation. There's significant changes, as an example, in Western Australia, where the legislation that they're proposing is that the tenant can stay in there for 5 years. So you can't do a short-term lease, right? So you can't do a 1-year lease, as an example. It still hasn't become law. So you need to be across that. So if you're self-managing, you need to keep yourself abreast of that. And I acknowledge Steve's comment that you'd have professional tenants, because the information is easy to get. They'll jump on a website, they got that, and they'll pin you down. And if you're going down the path of going to the tribunal, usually the tribunal, if it's not professionally managed, will side on the tenant's side, because they may have the more ammunition. So that leaves then obviously just the property manager, which is where everything hinges on, in terms of you need to select a property manager. And my suggestion is that if you're selecting a property manager, pretend to be a tenant, make an inquiry, because that's a big, big giveaway.
And to be very clear, there are plenty of rent investors out there. So they're on both sides of the fence.
That's right.
You know, years ago, I was one of those people. So I really think that's a great point, is to actually be the mystery shopper as a tenant, because there's not this segregation between, well, you're a tenant and you are, you know, substandard. And just because you're a landlord doesn't make you almighty
Yeah,
either.
absolutely.
And you also mentioned another important point. There's a few factors here that the professional tenant, or the dodgy tenant, I think as Alex said, is it a result of today's circumstances, or has this actually happened beforehand? And because there is some pretty big
That tells the science as well.
Absolutely.
You got to be careful at all. And to your point around professional tenants, and this is a property investment podcast, so I'm happy to be quite hawkish about it. The professional tenants are probably those who in late March come out and when the government announced policies around, you know, a moratorium on rent and evicting people. This is the group of people who came out saying, no one needs to pay rent anymore. Those evil landlords have been taking money from us for many, many years. So let's all get up in arms and spray paint walls saying don't pay rents against evil landlords. They're typically your professional tenants.
Yeah. Having said that, though, and if I look across our database of clients, and this is true, up until Monday this week, I think I've had 6 people, like 6 clients where clients have come to me saying that their tenants have requested a reduction. That's across Australia.
That's a lot of properties.
6 out of, a lot. It's not even a blip. Yeah. Out of the 6 that requested, 4 were trying it on. And I don't blame the tenant for trying it on. If you don't ask, you don't get. I mean, that's what we educate people.
There's in between trying it on and taking a piss, though, like deliberate. And I think I shared an example of the place where I live. There was a person in one of the flats who went to their landlord and said, I'm in hardship. I need a rent reduction. The landlord gave half of the rent reduction. They then rented this before the Airbnb stuff got canned or whatever it was, rented it out for 100 and something % of what she was paying for, put a couple of backpackers in there that couldn't get into a backpackers hostel in Bondi, probably infected by COVID from the eastern suburbs.
No assumptions here.
That's taking the piss. Well, and I went, that's not cool.
Yeah, it's not cool because that's taking advantage of other people's circumstances.
Absolutely.
And there's an ethical scenario here as well. We can't forget that.
Yeah, it is.
So coming back to the question, Phil, that one of the key things in here is that you need to get it professionally managed. Don't run the gauntlet of, especially with the amount of information available right now, to manage it yourself. And importantly, invest in landlord's insurance, because often if you've got a property manager that's professionally managing it and you do have, in inverted commas, the dodgy tenant, you would most likely be covered under your landlord's insurance.
You should do.
As of today's podcast, there is literally no insurers taking on new business for landlord components. So be very, very careful. So even as an existing landlord insurance, don't be swapping and changing insurers now if you already have
an existing relationship with an insurer.
Because you can't do it. And mental note, make sure you pay your insurance premiums.
Yes.
Phil Tarrant.
Because if it lapses, you've got to reset it, and they're going to go, no more landlord insurance.
Yeah, they'll reset it under the present circumstances.
Yeah, correct. Yeah, they would have. So make sure you pay your premiums. That was really good. Enjoy it. Q&A episodes. Thanks, everyone, for recording in. Please do it. Keep them coming. Just press on the record question now button on smartpropertyinvestment.com.au, whichever podcast you listen to. We'll get them answered. Today I had Steve Waters and Victor Kumar in the studio as the talent to help me navigate these questions from Right Property Group. Gents, thanks for the time today. It's really
Thank
good.
you. It's been a pleasure.
It's cracking sunset outside here. This time of the year is really nice sunsets out towards the east.
You're painting a pretty picture, mate.
Is it? Yeah, it's okay. It's nice. It's got pink hues and apricot colours. I hope you enjoyed that, everyone. Q&A episode, we'd like to do them, as I mentioned. If you're not yet tuning in to Smart Property Investment Show regularly, you can just subscribe wherever you're listening to this right now. smartpropertyinvestment.com.au is the website you need to go to keep abreast and engaged with what's happening in property. Smart Property HQ's the social handles. You can follow us there. Keep connected with what's happening. And please, a quick favour, should only take you a minute. Can you please leave a review wherever you listen to this right now? The team get a real kick out of it here. It's just not me behind the mic. There's a big team of really capable and passionate broadcast producers who make me sound good. So if you could do that, I'd really appreciate it. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Propertyology regards right now as a very exciting time for investing in Australian real estate. There are some fantastic opportunities that Propertyology can help you take advantage of before buyers re-emerge from their coronavirus cocoons. Propertyology has a national focus. Now more than ever, experience and knowledge are the most valuable currency. Propertyology has that in spades. To find out how Propertyology's multi-award-winning buyers agents can help you prosper, contact them now at propertyology.com.au.